Good morning, everyone, and thank you for waking up with us this morning to join the Silver Fox Advisors for our 2020 CEO Education Series. We are very excited to present the second installment of our four-part series on the pillars of business growth. My name is Joseph Tung, and I've been a practicing attorney in Houston for over 18 years, with the last 10 years under Tung Law Firm, which is dedicated to delivering concierge business solutions to owners and investors in a growth or pivot process. I am a proud member of the Silver Fox Advisors, which is a group of experienced business leaders that since 1986 has advised, consulted, and mentored the Houston small business community. Our goal is to enable and empower small businesses to be successful and grow. Before we begin with our panel, I want to take a few moments to highlight our programs. We host informative lunch and learn programs that typically meet monthly from January through October at the Houston Racquet Club. But because of COVID-19, we have migrated to a virtual format. Last month, we had Shelley Arnold illustrate all the exciting changes coming out of the Memorial Park Conservancy. This Thursday, we will have James Olson, the former CIA Chief of Counterintelligence, thrill us about the world of spies and traitors. You can sign up for the free online presentation at our website, www.silverfox.com. Our organization also supports 20 CEO roundtables for nearly 200 CEOs across the greater Houston area. These no-cost roundtables typically meet in person once a month, but with COVID-19, most of our roundtables have pivoted into virtually meeting every week. These roundtables provide valuable peer support and Silver Fox guidance during this critical time. If you are interested in joining a Silver Fox CEO roundtable, you can request an application and find more information at our website, www.silverfox.org. That brings me to the CEO Education Series, which consists of 4 sessions on emerging from COVID-19 through 4 pillars of business growth. Our first session, held in early June, focused on customer acquisition entitled Revving Up Your Business After COVID-19. Today, we will focus on financial drivers. Our final 2 education series topics are organization effectiveness in August, and finally, processes and systems in September. We hope that you find them helpful to your business as you navigate and emerge from COVID-19. You can register for all of these sessions at our website, www.silverfox.org. I would like to now introduce.
My name is Bill Herman, and I'll be kind of emceeing our talk today. We do have a pretty good group of panels here. Jim Griffin is a CPA and runs a public accounting firm in Sugar Land. Dick Hindy has over 40 years experience in the banking industry and is currently focused on helping businesses in their banking relationships, getting new loans, restructuring their debt, etc. Gerald has an extensive background in business. The most exciting in my mind is he was the CEO of Marefish Plumbing and Piping for a good 20 years. And has an extreme has a very diverse background. And each of these gentlemen, when they start to talk, will highlight a little bit more about their backgrounds. David has been a finance person for all of his career, both in public companies as well as nonprofits. He's sat on many boards and has an extensive background in helping businesses maximize their working capital. My background is I spent 20 years with General Electric in a wide assortment of jobs, about 10 of those years in finance and 10 of those years running businesses. Last 10 years or so in Houston, I was with a healthcare company, and recently I'm helping small businesses of various size get funding to start businesses and then to improve their businesses. So we'll go to the next slide. As I said, each of these gentlemen will add a little bit more when they get ready to talk. Today we're going to talk about driving business performance through your financials. And really what we've talked about, as we said in the first series, was how to relaunch your business after the virus and you're coming back online. This is really how to really understand. If we go to the next page, Doug. I do want to do a quick disclaimer. I'm sorry, I want to do a quick disclaimer here. The information we're going to share is based on all our experiences. We think it is complete and accurate and hopefully extremely useful for you. At the end of the day, it's you that has to take the information and act upon it. So we're here to support you. We're here to give you information, but ultimately it's your decision. So today's agenda, what we're going to do is break finances down in a couple different ways. The first one is we want to make sure you have a basic understanding of your financial statements. So we're going to go through 3 key financial statements and things that you should look at related to ratios and that as you look at those financial statements. The second area that David's going to cover is really how to effectively use your working capital. At the end of the day, cash is king. When you run out of cash, you're out of business. And so what we want to do is help you with some ideas on how to use your working capital effectively and how to maximize the creation of cash. Gerald's going to take us through an interesting feedback. He's going to sit in the chair of a CEO or a business owner and look at his monthly financial statements and share his experience of what he used to look at, how he used to interpret that information, and most importantly, how he used to act. I'm going to take us through how to use financial plans as a guardrail. Many of us think about budgets and budgets being, what did we spend last year? What can we afford to spend this year? I want to change that perspective and talk about how to use financial plans like a roadmap. So how do you look at where you're going to go 12 months from now and where you're going to be 36 months from now, and using financial plans as a guardrail. And then at the end of the day, most of us are funded by a funding source. We're supported by a bank. We might be supported by investors. And so we're going to spend the last segment of the agenda here today to talk about how to interact in particular with financial institutions. But I would say everything that Dick is going to share with us would work just as well with a shareholder base or in a group of investors. So I'm going to turn this over to Jim Griffin. Jim, I'd ask you to take a minute and just do a better job of introducing yourself than I did, and then take us through some financial statements.
I will gladly do that. First, even if somebody is not an accountant, it's really critical that they really understand their financials. The old saying goes, you can't manage what you can't measure. But first, you really need to know, how do these financials fit together and what do they really mean? Next slide. Okay, and so what we're going to do is we're going to look at the 3 most basic financials that are very important. And this is going to show you what your business has done up to a point. A little later, Bill will talk about taking what you've got and forecasting it forward. But obviously, the 3 basic financial statements are the balance sheet, the income statement, and the cash flow. And these are all very important statements, and you need to keep those current in your business. Next slide. And you may think it's a joke that you need 3 sets of books, one for the bank, one for the IRS, and one for you to run your business. But it is kind of that way in the fact that generally accepted accounting principles would have you record your information in a certain fashion. Tax accounting would end up with a different result, mainly because of how you book depreciation differently. And there's other subtle differences between the financial accounting that you would report to other owners or outside third parties and what you report to the IRS. You need to be able to reconcile those 2. And then the third is management accounting, where you may get further down into the details of the number to really figure out what you do. Now, I will say that most businesses, we recommend that you keep your regular financial accounting on the accrual basis, even if the IRS lets you report on the cash basis, because the accrual basis of accounting is a better match of revenue and expenses. Next slide. Okay, so the first critical financial statement is the balance sheet. And most balance sheets are going to be a little bit more detailed than this. Many small businesses use like QuickBooks or some other easier accounting system. I would recommend an accounting system of some sort versus just keeping your books like on Excel. Now, the 3 pieces of a balance sheet, of course, are the assets, the liabilities, and the equity. And if you're a successful business, the equity should be positive. And also the assets should be able to equal the liabilities and total equity. So that's it for the balance sheet for now. We're going to get into some more specifics here in a minute. Now, many of you may already be using ratios, but this is really, really critical. This is like you going to the doctor and getting a physical to say, hey, doc, how am I doing? Am I healthy? Do I have anything wrong? So again, I would like to spend a few minutes going through these. There's a couple of these that I like better than other ones. Debt to equity, total liabilities over shareholder equity. The two of the ones that I like even better are the current ratio, current assets over current liabilities. But the real important one for short term is the quick ratio, which is current assets minus inventories over current liabilities, to give you an idea of, do you have enough cash to get you through the short term? Return on equity, net income over shareholder equity. We also had things like return of investment was a term that we used to use in the 90s. And then we have return on average capital employed, which is the EBITDA, earnings before interest, taxes, depreciation, and amortization, over net capital employed. So again, it's very important to be looking at these ratios on a very regular basis. For example, the bank may say, hey, you need to have a current ratio of whatever they say it is. So again, Gerald's going to go into this a little bit, but you don't want to go out and buy a several $100,000 piece of equipment that's a long-term asset and use a short-term liability such as a line of credit to pay for that. You want to match up current assets with current liabilities, long-term debt with long-term assets. So it's real important, and some of you may need to go back in and re-engineer your financials, not in an Enron kind of way, but to look at what makes the most sense on the way your business should be run. And a little later, Bill's going to get into a little bit of benchmarking to give you an idea of how does it feel, or how does it look on your ratios compared to what your competitors do for ratios. Next. Okay, the income statement. Okay, and many times what we do on our clients is we also use all these numbers below revenue as a percent of revenue, so that you could quickly take a glance and say, okay, my general and administrative costs are X percent of my revenue this month. And another thing too you're going to have to look at is companies that sell a product are also going to have a cost of goods sold, and that gross margin percent is really, really critical. And Gerald's going to go into that in a little bit shortly. So again, your income statement is generally in three parts: revenues, expenses, and a net profit or loss. And hopefully that's going to be a net profit, not a loss. Next slide. Okay, a few other things that companies need to look at is the net income margin, which is net income over net sales. And some companies actually even break that down to three, where they have a gross profit ratio, an operating profit ratio, and then the net profit ratio, or the net income ratio. And what this does is this really is a report card on how effectively is the management or ownership running this company. Do they need to relook at this, and after they benchmark, say, hey, we need to relook at pricing. We need to look at some of our expenses that may be out of line, because it's very important to have a healthy net margin. The second part of that is the debt service ratio, which is your debt service over your EBITDA. And you'll hear from Dick Hindy, our banker, a little later. This debt service ratio better be more than a 1-to-1, or you're in trouble. You always want to have enough cash flow so that you don't ever have a problem repaying your bank. So at this time, sometimes what I do is I say, are you running your business as a lifestyle business, or as a real business? And what you do today really affects what your company is worth tomorrow. Next slide. Okay, the statement of cash flows. Okay, now what the statement of cash flows is it's a blend of the information from the income statement and the balance sheet. And it's going to take this cash flow over a period of time. So the way it's set up is the first part takes into account operating activity cash flow, investing activity, and financing activity. And many businesses that we see that are in a very rapid growth mode look like they're very profitable on the income statement, and they may be, but they have to have the cash flow to go with that. So again, fast growing businesses need to make sure they have a great bank relationship. And as David will get into later, will really need to work on their cash and their receivables. Next slide. Okay, here's some more key management ratios. So again, you may say, well, I'm not a CPA, I'm not an accountant, I don't want to spend that much time looking at this. I will say, if you take a little time and work on your business at the 30,000 foot high level, instead of just on an emergency day-to-day level, you're going to run a more profitable business. So some of these key management ratios are still very important. Asset turnover, revenue over average total sales. How fast are you flipping your revenue? Average collection period in terms of days. This is the DSO. David's got a couple slides later, and he does an excellent job of educating everybody on how this works on cash and receivables and flipping those sales. Inventory turnover is another thing. Cost of goods sold over average inventory. We have one client that is in the chemical business, and they have enough inventory to last them for the next 3 years. And I keep saying this is really not a good place to put your cash. So if you do have inventory, you really need a good system of tracking that inventory, so you're not holding on to a whole lot more inventory than you really need to be holding on to. Okay, and this is my final slide right here, is you really need to have somebody either part-time or full-time as an accounting resource, whether that is somebody in-house or somebody externally. I would say that if you do have somebody internally, make sure you have segregation of duties, because I'm also a certified fraud examiner in addition to a certified public accountant. And we've run into several situations where we've had to investigate where the key number one person in the business has been skimming, because they are very good at tracking everything from A to Z. And I believe David is going to get into that in a little later as far as a little of the segregation of duties. Okay, you need to have your information too very, very current. If you don't have your financials for 3 to 6 months, it's going to be very difficult to manage how you're doing if you haven't had your financial statements kind of really up to date. One other thing that I'll mention on that as well is think about driving down the 610 loop and only looking out your rearview mirror. That can give you the balance sheet, the income statement, the statement of cash flows, but you're going to get into an accident if you also don't do some forecasting. And Bill's going to go into that in a minute. So the last point is just to evaluate your accounting on a very, very regular basis, minimally annually. I even recommend that you do it quarterly or monthly. Bill has a 13-month model or 13-week model that he likes. And at this time, I appreciate you listening, and I'll be available for questions later. I would like to turn it over to my partner, David Newberger.
Let me grab this real quick, Jim, if I could. Thank you very much for sharing that with us. The key is the financial statements do give you a foundation, and as Jim mentioned, if that's all you're looking at, most of us don't understand that. Ask your accounting resource to help you give you a sheet of those ratios. There's something you shouldn't have to calculate. You should understand what they are, but that should be presented to you on a dashboard, as we'll talk about a little bit later. You can see by the first 10 slides of this presentation, this is a pretty detailed presentation. And probably one of the questions you're thinking is, can I get access to this? At the end, we will show you where we're going to store this presentation, both the physical presentation as well as a copy of the video. and you'll be able to have access to that. And yes, you will be able to print the presentation off from that source. So let's now that we understand our basic financial statements, let's talk now how to manage our business through our financials, and starting with working capital. So David, I'm going to ask you to again do a quick introduction of yourself and then to jump into your slides.
Next slide. Well, Bill and Jim, thank you very much. My background has been for almost, I guess, 40 years. I've spent a lot of time in corporations, sitting in all the chairs in financial management, from CFO to treasury, internal audit, managing general accounting, handling the day-to-day of accounting, focusing a lot in many respects on how to manage working capital. At the same time, I work very closely with my wife, who had a very successful business that was sold last year, and so I have a fairly good understanding of what's required by a small business to keep track of its cash and working capital. Next slide. In trying times, the adage, cash is king, is never truer. In today's world, ensuring an organization's working capital management strategies and process are best in class is again a high priority. Tighter working capital performance means well-timed inflows and outflows of cash, essential for companies operating on a small cushion of safety. I will review the 4 elements of working capital. These are cash, receivables, inventory, and payables. The net balance of these 4 accounts represents a company's net working capital. Next slide. Cash is king. Cash is the most important asset of every business. Without cash, a company can't pay its employees, purchase its required goods and services, pay its vendors. Without accumulating cash from its operation and building a cash balance in its bank account, the company cannot claim to make a profit and survive. This slide points out important issues in managing and controlling cash. Collectively, these points are defined as internal controls. Since cash is a company's most important asset, it's important that procedures are created that control access to cash and maintain integrity over its balance. These procedures operate more efficiently if there are 2 people involved. For example, the chief executive might sign checks, but another trusted employee should reconcile the bank account. Access to the bank account, which today should be facilitated online, should be limited to few people, such as the chief executive and perhaps a financial manager and accountant. Blank checks should be locked up in a safe place with few people having access and records. And you need to keep track of when they are issued and what checks have been issued. Finally, the utilization of credit cards should be limited. Next slide. With these controls, frequent reconciliation of the company bank account is imperative. This process should be limited to 1 or 2 individuals, but as stated, preferably not the individual signing checks. Since cash is king, it is very important that the company forecasts its cash balance at least monthly, and we believe quarterly. This forecast will highlight the collection of receivables offset by the payment of all expenses. It should begin with the current cash balance and net future inflows, receivables, with outflows, salaries, purchases of services, goods, fixed assets. The net of these calculations is the future cash balance. As with every forecast, it is important to compare actual results with forecasts so that management can understand the variance from plan. Generally, understanding these variances will improve the quality of future forecasts. Next slide. A company is in business to sell goods and services. This activity creates sales. Sales, in turn, generates receivables. Here are some thoughts on how to manage this important asset. First, invoice the customer for its purchases as quickly as possible. Delaying the issuance of an invoice will delay the collection of the cash. Second, ensure payments are clearly understood by the customer. Third, develop a procedure that maintains the list of outstanding receivables. Most accounting systems provide receivable reconciliation procedures. Fourth, pursue customers who are not paying their bills per their agreed upon payment terms. Next slide. A key metric in managing receivable is the development of a days sales outstanding calculation of DSO, which is the division of a company. Oh, I made a mistake. Go back. Go back to this slide. Go back. Stay on number, I'm sorry, the next slide. It begins adopt credit policies consistent with your industry. Next, understand your customer's payment process. This is critical. When a customer's payments are slow, it's important to know the key individual at the customer who controls the payment of invoices. Seventh, frequently forecast collections. This is a key element in the cash forecasting discussed earlier. Next slide. No, the next slide. Here we go. A key metric in managing receivables is developing a formula known as DSO, or Days Sales Outstanding, which is essentially the division of current receivable balance by average daily sales. If a company's payment terms are payable upon receipt of invoice, an acceptable DSO would be between 10 and 20 days. If, however, the payment terms are payable 30 days from receipt by the customer of your invoice or the invoice date, an acceptable DSO would be between 35 and 40 days. In other words, even though your payment terms might be due upon receipt of invoice or payment 30 days from the invoice date, it's probable that your customer is not going to send their payments so that you receive that cash exactly under those terms. Therefore, you can expect that your actual day sales outstanding is going to be more days than your actual payment terms. But these dates we're showing you give you some insights into what can be considered acceptable. And when the customer isn't paying per your terms, don't be bashful about calling the key individual mentioned above in the earlier slide and asking for payment. I've done this many times. Next slide. Manufacturing companies sell products which are produced and accounted for as inventory. Service companies also may have inventories, which are triggered by services they provide. Here are some important thoughts in managing these assets. First, maintain a perpetual inventory system. Ideally, this will be included in your computerized accounting system, rather than via manually maintained handwritten ledgers. Second, count the inventory frequently to ensure that the system balances are correct. A periodic cycle counting procedure is valuable, but an annual physical of the entire inventory is mandatory. Next, develop procedures to measure the turnover of the inventory, identifying slow-moving inventory and developing plans to utilize these items. A frequent way to measure, to do a measurement of a day's inventory is just to divide the inventory balance at a certain point, divided by the average daily cost of goods sold of what's been sold. If in these analyses you find slow-moving inventory, you should develop plans to utilize these items. Or if these items actually aren't saleable and become obsolete, they should be removed from the inventory and written off. Finally, in valuing the inventory, it's important to develop a robust or a detailed cost accounting system should be developed that accurately values the inventory. Next slide. When a company purchases goods and services, its vendors send invoices. Unpaid invoices are defined as payables. Here are thoughts on managing this liability. First, record all invoices into an accounting system as soon as received. Again, we keep mentioning accounting systems, and Jim mentioned it before. In today's world, I would assume that most companies have some form of an accounting system, as basic perhaps as QuickBooks. But an accounting system on a computer is very, very valuable and available in today's world. Second, after you record the invoices, track their due date, and pay vendors on the due date. Ensure that invoices received include the agreed upon due date and that the purchase was authorized by an approved purchase order issued by a key individual in the firm. Make sure that people aren't sending purchase orders to vendors without approval. Next, ensure that the items covered in the invoice were actually received by somebody in the firm, and it's noted. Fifth, if the issues exist with the company's ability to pay timely, don't hesitate to call the vendor and explain your rationale for being late. Open communications with the vendor is the best tactic in effectively dealing with these situations. This is similar to the comment made about receivables. It's very good to have a good relationship with not only your vendors, but your customers. Finally, take all discounts. This point will be further developed by Gerald. This concludes a review of net working capital. Remember, the best working capital management systems feature a very low DSO, the fewest days of inventory on hand, and payables that are current. Thus, the cash will be king and it will be managed efficiently. Now I'll turn this over to Gerald, who will explain how a company can effectively manage its operations by developing effective metrics.
Thank you, David. Hi, my name is Gerald Murfish. I have 47 years of business experience, spending my first 5 years as a lender at a commercial bank, and then the next 42 years running as an entrepreneur, my family's business that's now 100 years old. In 2012, my sister and I sold that business to JP Morgan Chase One Equity Partners. In addition to my business career, I have an extensive nonprofit experience, having a leadership and board experience with the United Way, the MS Society, HISD Foundation, the National Association of Steel Pipe Distributors, and the Jewish Community Center. I hold a bachelor's and a master's degree from the University of Texas at Austin with concentration in finance. So if we can go to the next slide, please. I want to ask you to think of the business cycle for your business. Today's education course attendees likely represent all types of businesses: manufacturers, distributors, service companies, contractors, professional service companies, or even nonprofits, to name a few. Hey, Doug, that's a picture of Bill up there. Might you put up my picture, please? Each business has what I call a business cycle. So the cycle starts with cash, then it's indicated on this slide at the 4 o'clock position, an investment or purchase or staffing is undertaken. For example, let's use a widget distributor. The widget distributor buys inventory that they hope to sell. If it's a widget manufacturer, they install machinery and buy raw materials to manufacture the widget. If your business is a service provider, you've made an investment in staffing. In any case, the transformation to cash as some product or service is a place where leakage can occur. Maybe it's poor operations, or operating costs are too high, or staffing's more than is really needed. Your product service is sold, and we move clockwise to the 7 o'clock position. Here's another place where leakage can occur. Your material is not properly invoiced, or maybe it's not invoiced at all. Your customer makes a claim for defective or short ship material, or your customer never pays. In any case, if all goes well, the customer pays and you get back to cash, hopefully spinning off some profit, and the cycle begins again. So think about your company and your business cycle and tighten up your cycle where you can. Profits are hard enough to make today. You can't have any waste. Next slide, please. In my career, I always viewed, in my life, I'm 69 years old, always had annual physicals. I thought it was important to keep track of my health. Well, you have to treat your business kind of that way, and that you need physicals, but they need to be done every month, not once a year. If you tend to this and you do this monthly and regularly, you will foretell possible issues, and you can avoid them. Next slide, please. So as the business leader of your business, it's important that you conduct that physical. Do not let the quality of your assets deteriorate. If you're a service company, keep key employees satisfied and focused on working hard. If you're a distributor, make certain you avoid technical and physical inventory obsolescence and that your inventory remains sellable. Debt. Use your debt effectively. One of the do-nots of financing is to use short-term debt to finance a long-term asset. In other words, do not use a 90 or 100-day loan to finance a plastic injection machine that might last for 5 years. The term of the debt repayment should generally approximate the life of the asset. Inventory. Excuse me. All businesses have A and B items as well as C and D items, referencing them as far as their velocity. Service companies and service providers have things they provide to customers often and some not so often, but they have to be ready to serve the customer when asked. Price that item accordingly to represent the investment you have in that product and the time you have held it. It's kind of a concept of turns and earns. C's and D's don't turn as quickly as A's and B's. So you have an investment in them longer, you should make a bigger margin. Drive efficient economical operation activities and focus on completing the business cycle by collecting the funds owed to you. Lastly, understand that the higher your return on net capital employed, the more efficient your business utilizes its capital and the more your business is worth when you're ready to sell it. A high ROACE will generate a higher EBITDA multiple and therefore a higher price when it's time to exit your business. Next slide, please. So this is an example of operating leverage. So operating leverage is an interesting and valuable technique that can result in higher income. Focus on growing your company without your sales and general administrative costs growing at the same pace. In my business, we strove to maximize our operating leverage to maximize profits. In this example, there's substantial sales growth, but because the company grew sales while maintaining the same gross profit margin, and by efficiently managing their operating costs by not allowing these costs to increase at the same rate as sales, the company experienced substantially higher profit margins. Think about how you could do this with your company. So sales grew 68%, gross margin stayed the same at 59%, Operating expenses as a percentage of sales actually declined 14%, and net income increased by a whopping 130%. Next slide, please. Financial leverage is the use of borrowing funds to finance your business. So it's common knowledge that companies need capital to grow and prosper. The additional capital needed may come from retained profits or from third-party financing. Equity capital is almost always more expensive than debt, so having the proper combination of equity and debt capital is advantageous. Whatever the source, the capital needs to be wisely invested in the company to create more profits without burdening the company with too much debt. My family's business was very capital intensive, so the use of debt was a necessity. We had to be careful not to have too much debt and a high percentage of financial leverage resulting in excessive financial risk. In this illustration, the company begins to borrow funds in 2019, adding more debt in 2020 and 2021, but the debt does not result in increased retained earnings. And in time, the debt ratios reflect much higher financial risk and falling returns on equity. This illustrates that financial leverage, although beneficial, can become a problem as borrowed funds require paying interest as well as repaying the capital. Next slide, please. This slide shows a number of financial ratios that I track each month. And I watch the trends of these ratios because they can foretell a looming problem, a problem with foresight you can manage and overcome. Later in today's presentation, Bill Herman will give you information about where you can go to get these average ratios for your industry. Each ratio is important. The most important thing is to examine these ratios over time and concentrate on trends. Secondarily is how each ratio compares to the industry averages. So as you can see here, we've illustrated the industry average and then 4 months, and you can see trends in these ratios. I know that for our family business, the industry averages were not really that important because we were being compared to companies that were not as capital intensive. They turned their inventory many more times than we could, but we knew, but knowing that we were more capital intensive, we concentrated on generating higher profits. So ratio averages for industries compared to your company need to be considered accordingly and specialized to your particular situation. Next slide, please. I want to take a moment, next slide, please. I want to take a moment here to give you a way that you can analyze whether or not you should get a discount on an invoice. So in this case, if you'll see, we make an assumption that you've got a $10,000 accounts payable with cash terms of 2% 10 days, net 30. And the invoice date is June 1st. So if we figure out then how many periods of So to pay it on time, we pay it in 10 days. If we didn't pay it on time, we pay it in 30. So that means there's 20 days that's costing us 2%. If we figure out the number of 20-day periods that are within a year, 18, we multiply that times the interest deduction loss of 2%. That gives the net effective per annum interest rate of not taking that 2% discount of a whopping 36%. If you're borrowing funds to take advantage of cash terms, if the net effective per annum interest rate of the cash term is greater than what you are paying for borrowed funds, and the funds are available, pay the invoice and take the discount. If you're not borrowing funds, then the net effective per annum interest rate of the cash terms, and if you find it attractive, pay early and take the discount. In my company, we offered cash terms, and if a customer did not take advantage of the cash terms, it indicated to us that the company was under financial stress. Inevitably, many of these companies were the ones with accounts receivables that we had to write off. When we were offered and took advantage of cash terms, we found that taking advantage of those terms indicated to our vendor that we had the required financial strength to be worthy of special offers. No company wants to make a special priced offer and then not get paid. Next slide, please. Insurance is a major part of the judicial financial management. Buying insurance is a way to mitigate exposure to risk, some of which could be catastrophic to your business and you. What you see here is a quick list of the common types of insurance that a company usually has. Let me point out that professional liability insurance is for errors and omissions that is suitable for companies that offer advice, like engineering companies, architectural firms, insurance agents, as examples. Let me explain how an insurance broker works. Insurance agent broker work. So as to insurance broker, it's important to engage with an informed insurance broker. However, let me explain how that works. Insurance companies, for example, Chubb, Fireman's Fund, Hartford, or Travelers, perhaps a few names you might recognize, only allow one broker at a time to offer their product. So it's very hard to truly set up a competitive situation unless you allow a number of brokers to compete. If you can set up a competitive situation, be certain that no broker represents more than 2 or 3 insurance companies. For example, broker A might offer insurance from Chubb and Hartford, while broker B offers Fireman's Fund and Travelers. I expect that many of you probably have a close personal relationship with your insurance broker, but you'll never know how much extra you're paying unless you can set up a competitive landscape. For our company, some 20 plus years ago, we hired an insurance consultant who did not sell insurance at all. He helped us so we were not only properly insured, but also that we had a competitive quoting process. He paid for his annual fees many, many times over. Maybe your insurance package is large enough to use an insurance consultant. Next slide, please. This is a team of support advisors that we recommend that you organize. Do not wait to find these types of advisors until you really need them, as you might not find the ones you want due to the time predicament. Of course, the person needs to have skills, but also you need to have confidence in the guidance they offer, and that takes time to establish. Not all companies participate in today's call has a board of advisors. It's the last item on this list. As a CEO, it's pretty lonely as a leader of a business. People are reluctant to offer critique as they do not want to point out things that need to change. A good board of advisors can help you get the feedback needed to do a better job and to maximize your business. But they can also offer you creative strategies and approaches that they have deployed in their careers that can be of assistance. Further, the process of preparing for a board meeting will force you to gather and analyze information that you might be inclined to put off or ignore. I currently serve on 2 for-profit boards, and the CEOs of those companies receive substantial returns on their investment through our board participation process. Thank you, and that's the end of my presentation.
Joe, thank you very much. I want to let everybody know, at least the panelists, that we are having a Zoom technical issue. So when you're up, please hit your video directly. Our production controller cannot do it for us. So I'm going to go ahead and take us forward now into financial plans. Real quick on my background, as I mentioned earlier, I am an unlicensed CPA, which means I'm not a practicing CPA. Not that I went to jail or anything, but an unpracticing CPA. I spent half my career in finance, major roles of the chief financial officer for some business units within General Electric. And I used to tell my folks that it isn't our job to teach our clients or our customers finance. It is our job to talk to the operating people in their language. And that's, again, I want to really reinforce what Gerald said a minute ago about dashboards. We used to present dashboards more often than we presented financial statements. And we used to talk about the drivers within those. And that should be the role of your finance person. I switched over after half my career in finance and ran businesses. And I will say that financial footing was very helpful, but also what I just said about speaking the language of operations versus the language of finance really came home to roost with me. One of the biggest things we used to do as finance people was help a business see its future. And what we would talk about that is, Doug, if you go the other way, I'm sorry, if you sit right there for a minute, is to help them see their future. And what we mean by that is if you were saying, I'm going to go to the West Coast or I'm going to go to California, that's a nice dream, but you would take out a map or you would do some investigation, say, what's the best way of getting there? What will it take to get there? How much money will it take to get there? What will we do when we get there, et cetera? And so think of that as your financial plan. As a business owner, you should be really talking to your team in what I would call financial tenets. What are the bases that we want to operate this business to? And I'm going to give you examples of that in a minute. And I would use those tenets as a way to describe what is the success of the business. It isn't just that we made money. It isn't just that we created some cash. It is that we hit certain parameters, and that's what I'm going to call tenets. Number two is you should go into a year with a plan. So again, if you're going to go to LA, you have a plan for getting to LA. If LA is your destination 3 years from now, then you have a 1-year plan, a 2-year plan, and a 3-year plan that delivers you into LA. And that 3-year plan should be a rolling plan. So every year you're now projecting out 3 years. Maybe the following year you want to go to Honolulu. So you've now made it to LA. Now you want to move on to Honolulu. That's critical. The first year of that 3-year plan is obviously your next year plan. And that allows you to communicate your operating goals, make sure you're spending the money where you want, so your investment objectives are clear. And more importantly, your operational team have the action plans to bring your plans to life. You want to continuously use financial indicators to look at your course for course corrections. Again, those ratios that we were talking about earlier, other indications from the marketplace. And then you use your performance against these plans to measure and communicate success. So let's talk about operating tenets. We'll go on to the next slide. And I have seen this throughout my career. General Electric lived with this. The other companies I was with, the small companies I operate that I help now, I try to encourage them to look in their businesses in this term. So let's say you're a growth business and each year you're growing and you think, God, it's great. We doubled this year, or we grew 15% or whatever. That's good, but the reality is, what was your goal? If you grew 50% and you could have grown 100%, is that good or bad? And so what I would be communicating to everyone is, what is our growth objectives? We want a 20% annual growth rate for the next 5 years. We want to manage our price so that we are maintaining our price, but more importantly, increasing our average sales price by about 1%. If I'm in a service business or a manufacturing business, we want to introduce 1 new service or product a year, or 2, depending on where we're at. The reality is, if you're not introducing something new, then you're probably stagnant. Your customers are going to move on. The other advantage of introducing a product or service is that's a great way to manage price. If you think about a refrigerator or something that over these years, each time they brought in a new feature, it allowed them to maintain the price of that refrigerator. Electronic companies do it all the time. Apple does it. They introduce a new product, a new feature, they up the price. So if you're not introducing new products and new services, then you're stagnant and probably heading backwards. We talked about operating leverage. Gerald talked about it a little bit ago. So the focus is here is how to have a 4% improvement in our gross profit margin. That's the difference between your revenue, what you build and collect, and what was the cost to create that revenue. And that's our gross profit margins. We want to see that improve through a better mix of products, through a higher price point, et cetera. And then, as you talked about with operating leverage, how do you grow your gross profit without growing your base cost? And so we want our G&A cost to be less than 2%. And then turnover is extremely expensive. So we want to have voluntary turnover very low. Before we move on, I just want to really highlight, if you talk to your employees in this term, and you talk to your staff in these terms, now everyone understands what are the requirements to define success. Some of you are a little scared to share your financial information with your employees. I understand that, but it shouldn't be any issue to understand your operating tenets, sharing your operating tenets with your employees, and telling everyone every year, how did we do against these? So let's talk now how to turn this into a plan and go on to the next page, Doug. And so if our goal in gross revenue is 20%, we used to put a team of people, you know, the marketing people, the sales people in a room and say, okay, we have to hit 20% this year, we have to hit 20% next year, we have to hit 20% the following year. Let's start breaking down where that comes from. Here's a list of questions, and I'm not going to go through every one of them, but obviously they deal with what is the behavior of your customer, what is the behavior of your marketplace, and what is the behavior of your products? Are they aging? Do you have new products, etc.? So think about it in those three categories. I do want to highlight what I put in bold here as letter F. Do not accept in a plan from your team, we cannot reach that goal. All right? Even if it's a stretch, how do you fill in the gap? And I will tell you, in my 30-some years of experience, both as a finance person and a business owner, people minimize their capabilities. And that's why we never worked with a budget. Budget to us was a negotiation of minimization, because when you put a budget out there, people want to hit that budget, so they want that budget to be as low as possible. That's an exercise in minimization. We want a plan that hits our operating tenets. So if 20% is the goal, and we add up all our initiatives in the 3 years, and we're at 18%, 21%, and 10%, we got to go back to work. We got to put the team back to work, and how do we get to the 20%? Most of us deal with a sales force. Sales force typically works off incentive plans. And so I would challenge you every year to sit back and look at your sales incentive plan and see what's working and not working, so that you can keep those guys fired up about your product and interacting with their customers. Let's go on to the next page and talk about the expense side. So again, in the delivery of that product or the service, your costs are not going to be stagnant. You're going to have inflation. Your material mix may not be available. The vendor may no longer sell with the particular material you want, so you had to replace it. What's critical here is, again, an evaluation. How are we lowering the cost of delivery? And now what's interesting is a service business can think of that too. I spent 30 years of my life in healthcare, and most of us don't think about improving cost in healthcare, or as patients, we think our healthcare cost always goes up. But the reality is there's so many things in that delivery system that you have a chance to improve. And whether it's through automation, whether it's a more effective use of computer programs to do better estimating, whether it is material costs, who is focused on lowering your cost of delivery? And that's a critical point. When you get to G&A, the biggest thing I found with G&A is G&A typically is not owned. It just happens. And so one of the things I always counsel people was, if you have a sales and marketing account, you have an insurance account, you have a professional services, you have telephone, you have communication, assign a particular person to every one of those accounts, all right? So you own telecommunications. Your responsibility is to have that not increase this year, or we need a 10% reduction. You need to tell me every month what you're doing to improve that. What are you exploring? And it's interesting, once you start assigning someone and you're holding them accountable, they're going to get innovative. They're going to figure out different ways to lower that cost, because that's their personal job, and they'll approach it with some high level of energy. So don't accept the G&A costs as this is what it incurred this year. Have someone proactively manage each one of those accounts and that they're reporting out to you. We go on to the next slide, please. We had mentioned earlier that there's a way to get the different services to get industry benchmarks. This is one of those, called profits and cents. I've highlighted it here where you can get to the website where you can get to their services. You will need to look up what is your ICS code, your SIC code, and get something as close as possible. Gerald had mentioned earlier, he created an industry comparison that wasn't quite exactly to his company, but it was pretty close, and allowed them to have a benchmark It allowed them to see what those other companies each year, what's happening to those benchmarks, and allowed him to focus on his improvement. What's nice is it gives you a sense of how are we doing versus other people, versus, again, just looking at yourself and saying, hey, I think we're great today. And you might be, but if you look at other people, you might find that you're not quite as great. This really helps you, I think, shape those operating tenets, because you can see what your industry is doing on those couple key benchmarks, and you could set your benchmark accordingly. Go on to the next slide, and we'll start pulling this together. So again, this is an income statement pro forma over 3 years, right? And it gives you a breakdown of items. It shows you year over year what's happening. This particular pro forma is a startup company, so you see some really unusual companies. And then what's happening here is you can see their business growth. You can see their cost of goods sold. So again, those are the items that they use to produce that revenue. You get your gross profit margin. Again, nice growth here. And then you can see the operating costs. Now, I agree with what Gerald said earlier. I always lived off percentages. And so I would want to know what my sales and marketing costs are as a percent of net revenue, what my G&A costs are, what are my direct customer acquisition costs, et cetera. It's a little not quite as apple on this particular income statement because it's a startup company, but that is clearly, you always want to look at a financial statement in absolute numbers in the relationship to net revenue. If you move on, please. In this case, you can see the key is really the net revenue growth. So again, I don't want to know the outcome. I played baseball all my life. I played baseball in college, etc. I didn't just look at the final score. I looked at the things I did during the game. And when the coach was talking to us, we had different strategies during the game. Hopefully, the good executional strategies, the scoreboard at the end showed that we won. So the financial statements are like that scoreboard. It's the end product. Let's talk about the things that it will take to execute. So in this particular business, what is key is growing the database of potential customers, all right? And then how to leverage that database to get customers. And so again, that's a key thing. And we're going to talk about now action plans to bring these to life. You can see the average dollar purchases per customer stays pretty stable. So we got to have the right products, we got to have the right price points, and we can maintain this over the 3-year period. Our marketing spend obviously will increase as this business grows, but as a relationship of what we're spending to acquire customers, it goes down. If you go on next, please. So this is again, a visualization of how to bring those customers to life. What is happening what events are happening to bring those customers forward? And so again, very important, very visual. Your team isn't looking at financial statements, they're looking at actions, which takes us on to the next page. Now we have the operating dashboard. So this is different than the financial dashboard. This is what I like to call who, what, and when. What's going to happen, who's going to do it, and when is it going to be done? Now, when I ran businesses and we were very active in growth, I seemed to always have a growth business that I was responsible for. I had my key team come together every Friday, and this kind of a dashboard is all we looked at. And the person putting the meeting together, our project manager, would give me an indication, what we would call the traffic lights on the right-hand side, red, yellow, green. Obviously, red meant this was in trouble. And Sam would have to explain to us what is happening here, what do we need to correct, what other resources did he need to bring this to life. Yellow was, we better pay attention to this over the next couple of weeks. And green was right on course or potentially completed. But the interesting thing about this, as we all know, is people do what you review. And so if you're running a company and all you're looking at is your revenue line, everyone's focused on how to get the greatest revenue. Honestly, they might be giving away price. They might be pushing the product that has the lowest margin. They might be allowing inventory to build in the back. And more importantly, if you're looking at revenue, they might be selling things to customers that aren't paying you. And so your receivables look bad. So the importance of this is balance. Have a 3-year plan. Know that you're trying to get to Los Angeles. Have the details of how to get to Los Angeles, and then hold regular meetings to hold people accountable for the execution of that plan. If you happen to be a sole practitioner or a small business and it's really you, this is where the board of advisors come into play. If you had, and then you need to be a board, if you had an outside advisor that was holding you accountable to your operating tenets, holding you accountable to the actions it takes to bring this to life, you'll be a much better manager and owner of that business. So in summary, if I go to the next page, last page, please. Planning, and I like to call it the doing process. You should dream. As human beings, we have a tendency to minimize ourselves. We hold back. We create reasons that something can't happen. So I'm going to ask you to start your planning process by dreaming. Don't create barriers. Don't let people in the room tell you what you can't do. I was with a company and I happened to be on a small group that we called it the growth group. And we would meet every Friday, and obviously it was a big company. We would talk about businesses that we could buy. The president of the company would not let lawyers in the room. And their biggest reason was he didn't want the lawyers saying, you can't do that, can't do this, can't do that. There was a time for the lawyers to review, but it wasn't during the dreaming phase. He did not want to hear the barriers. So dream, create opportunities. Bring that dream to life through plans. Focus on the 3 W's, who, what, and when. And then the last is, as you're driving to LA, make sure you're monitoring to make sure you're hitting the milestones that you have in your plans. So monitor your plans, proactively adjust. Over 3 years, the environment around you will change. It shouldn't make you change your expected outcome. It might have you change your actions. And with that, let's move on now to Dick. And Dick's going to bring his banking experience to life for us and talk about how to deal with financial institutions. So Dick, if you hit your video, start, the stop video, but it should be, take that off stop video and we'll be able to move forward. So thank you. Dick?
Yep, I'm here. Everybody see me? Okay, great information that the other presenters, my fellow colleagues have presented. And now when you have all this information all compiled and in a nice, neat package, you can go to your bank and ask for money. So I'm going to talk about dealing with your financial institution, not only as we come out of this and work through this COVID-19 crisis, but also going forward. And when I talk about banks, I'm talking about commercial banks, savings and loans, and credit unions. So hitting the full gamut. So the next slide, or first slide. What we're going to cover is loan payments, a little bit of discussion about the PPP loan and the forgiveness, and then new loans going forward, and then dealing with your financial institution and ongoing relationship. Before I get started there, I forgot to kind of give you a little bit of overview of my background. I was in banking for more years than I want to admit. It was almost 47 years before I retired. And now what I do is I help small and mid-sized businesses with their banking relationships, doing a business plan for them, restructuring their bank debt. For some strange reason, most business owners don't like to talk to their banker. It's like talking to their doctor. And so they're a little bit intimidated, I guess, by going into the big bank offices. So I try to be that mediator between the small business person and their banker. Loan payments. When we all started this COVID-19 crisis was in the late March, early April timeframe. And a lot of businesses went from revenue to no revenue almost overnight. And most of the banks offered deferment payments for their loans. and those payments were usually in 90-day deferments. And so if you were one of those businesses that did take a 90-day deferral of your payments in April, those payments are all coming due now in July. Maybe some of you decided not to take a deferment or didn't ask your bank, or maybe your bank didn't give you a deferment. So you've been making your payments all along, but you may find with 4 or 5 or 6 months worth of no revenue or little revenue that making that next payment is going to be extremely difficult. So next slide. So I put a red flag over here because bankers hate surprises. And before you wait till the day before your payment's due, or you get a past due notice from the bank and you decide, oh, I better do something about this, I would strongly recommend that you plan ahead. You kind of should know where your cash is and what kind of revenue you have coming in. And so if you can't make that payment, schedule a meeting with your banker and go in and talk to them and say, look, I've got continued problems here, issues with no revenue. I need another 90-day deferment payment, or maybe a suspension of payments for a year. And here's my plan where I can start making payments. What can we work out? But again, don't wait till the last minute to do that, because banks really hate those surprises. A little bit about the PPP forgiveness program. We're all working through that, and the SBA, I think, is probably on the verge of almost coming out with their finalized form on how everybody's going to fill that out and turn it into their bank. What I think is going to be a really good process, because the banks have a period of time to review it, and then they send it on to the SBA. And I'm sure the SBA is going to be buried with these forgiveness programs. So the more information and the better your records are, the easier chance you're going to have of having that whole amount forgiven or a major portion of it. A lot of my clients, I recommended to them when they got the PPP money to set up a separate account and just take advances from that PPP separate account into your operating account to cover your payroll. If you didn't do that, kind of commingled all the monies together, the more detailed information that you can have either from your payroll provider or copies of transfers that you made to a payroll account, the better off you're going to be. A lot of the payroll firms have developed their own special reporting too for attachments to the PPP forgiveness. I wouldn't wait again here until the last minute. Most businesses that took PPP money early had 8 weeks to go through their PPP money. That's all been extended to 24. And so I would recommend that you use that 24-week option, make sure all of your PPP money is used for the payroll and rent payments and bonuses and other legitimate expenses. And then get it all put together and take it to the bank maybe 30, 40, 60 days before it's due, and not wait till the last minute to walk in with a shoebox full of information. Sometimes we all look at information over and over and over again, and I would recommend that before you go to the bank with that PPP stuff detailed, have your accountant or an advisor also look at it and make sure that all the I's are dotted and T's are crossed, and it'll just prevent some real problems for you going forward. Okay, next slide. On the PPP forgiveness, I've had a lot of clients that have been kind of overly excited or worried about, what if I don't have all of my PPP money forgiven? What do I do then? Well, what I've been recommending to my clients is that if you do have a balance, it's not forgiven, it's not the end of the world. And certainly don't pay it off. You'll never find, and there'll never be an opportunity, well, hopefully in our lifetimes, where you can get cheap money at 1% on an unsecured basis for as long a period of time as up to 5 years. The lender has to approve the 5-year period, but I think most lenders are going to be receptive to that. And so going back to what David and others have said in this presentation, that cash is king. So I don't know why you would want to use $100,000 you have in cash to pay off a 1% loan to the federal government when they'll give it to you for 5 years on an unsecured basis. So just some words of wisdom and advice there. Lock in that balance that's not forgiven and take advantage of that low rate. Next slide. New loans going forward, I think, are going to be extremely difficult on the underwriting process. The banks are going to be having a lot of problem assets where real estate loans can't be paid because borrowers haven't paid their rent payments or have gone to a deferment basis or maybe have gone out of business completely. So they're going to be tightening up. Usually when banks have problem zones, they tighten up on the credit underwriting, and the regulators make them do that. So if you're thinking about once we all get through this COVID-19 crisis and I'm going to have to go in and borrow some money, be aware of some of the things that are going to happen. You're probably going to need more money down. And what that means, if you were previously looking at a piece of real estate and the bank said, 15% down, and we'll do the deal, or 10% down on an SBA 504, you're going to be looking at probably 20, maybe 25% down. If you're purchasing a piece of equipment, some banks I know are doing 5% down. I think you're going to see bigger down payments there, requirements of 10, maybe 15%. The terms are going to be shorter. And what that means is in uncertain times, banks don't like to do long-term loans. They don't like to do 5, 10, 20, 30-year loans. So if you do get approved for a loan, it's probably going to be for a 2, maybe 3-year period. And the amortization period may be longer, but that shorter maturity is going to give the bank an opportunity to look at that loan when it comes due, see if they want to renew it or extend it or modify the terms. In a decreasing interest rate environment, that could be a good thing for you. In an increasing interest rate environment, that could be a bad thing for you because you're going to pay a higher rate. The lower advance rates, I think, are also going to be a new thing. And what I'm referring to there is if you've got a line of credit where the bank is extending you 80% of your receivables 90 days or less, that advance rate's probably going to drop. It's probably going to be closer to 70, 65% of anything 90 days. And the reason for that being is that you may have a receivable on your books, but who knows if the company on the other end is having more problems than you are and having no sales and doesn't look like they're going to have any sales for a long period of time going forward. So those advance rates are going to be a lot lower. I think a lot of you business owners experienced that maybe when you went into your bank, and a lot of my clients that were using big banks, I won't name them, but they thought they had a really good relationship with that bank, and the big banks kind of blew them off on the PPP. And so a lot of small businesses went to the community banks, and the community banks extended them the PPP loans because they were getting compensated by the federal government for making those. Going forward, I think if you got one of those PPP loans at a community bank and you don't have your checking and savings and other types of accounts with them, they're probably going to be hard selling you on that because they all want a relationship, and I'll talk a little bit more about that going forward. But the onesies and twosies are going to be a thing of the past. The big problem is going to be trying to develop projections. Banks typically look at 3 years worth of historical numbers to see if you can service the debt based upon those 3 years. Well, we're sitting in Houston, Texas, where 3 years ago was 2017, and we all know what Harvey did to a lot of businesses. They had an interruption in revenue. Businesses were closed for maybe 30 or 45 days. So 2017 is not going to be a good number to look at. 2018 and 19 were good years, and now we're into 2020, and you're not going to have good numbers there either. So when you walk into a bank and want a new loan and looking at projections, they're going to ask for extreme amount of detail on how did you arrive at those projections. And so be prepared to not just give them the numbers, but to have narrative on, yeah, I'm going to do this, or we're going to do that, both on the income and the revenue side, as well as your expense side. Next slide. Okay, now we're going to get into the whole banking realm and world, the secret world of banking. And I always used to tell my loan officers that worked for me when I was banking that the color of our money is just as green as the bank across the street or down the street or across the country. But what makes us different in our bank is the individuals. We take more responsibility for our customers. We try to set a good relationship with them, know their business as well as they do. And a lot of that's gone by the wayside because the banks today, there's not a whole lot of bankers that have any decision-making policy. They're kind of like marketing people and salespeople, especially in the bigger banks. And so I would recommend that you do some research if you're looking for a new bank and try to find a community bank and try to find a banker that has decision-making policy in power, because they're the ones that are going to be the ones that you can go to for advice and not have to go to a loan committee and wait for a long decision to be made. Next slide. When you're dealing with banks, a lot of people think that they're going to be able to get a very attractive interest rate. And they do, lower than you could get from an investor. And the reason for that being is that banks don't want to take on a whole lot of high risk. And so if you're in an environment where the market rate is 5% and the bank is going to charge you 6% or 7%, that's pretty good average for risk for a business loan. If you're looking at an investor or a equity partner to come in, the rate of return that they want are going to be extremely higher than 5 or 6%. They're going to be in the double digits, and they're going to want maybe some decision-making power over your company. So don't look at that 5 or 6% or 7% even as an unruly rate. It's the bank's getting compensated for a little bit of the risk that they're taking. They don't want, in the event of a meltdown, though, for them to lose any money. So they try to take collateral or seek collateral to protect their interest, but they're not making that loan based upon the collateral value. That's one big mistake that a lot of people think that, okay, I've got a piece of equipment that's worth $100,000. I should be able to borrow $100,000 against it. That's not how the banks operate. And again, banks want a total relationship, not just a single transaction. And I'm going to talk about that a little bit more even later. And I'm wanting to impress upon you that fact that don't just look for your bank to make a loan, give them your whole banking relationship. Next slide. Bankers don't want to be your business partner. They don't know how to make widgets. They don't know how to operate a retail store. They want you to do that. And they want you to come to them with really hard facts and figures and requests. One of the things that I used to dislike when people came in with information was, okay, here's all my information. How much can I borrow? Well, that demonstrated to me that they're probably not very attuned or on top of their business, or they wouldn't be asking that question. They have a specific need and know how much they need to borrow, not throw that on the table as how much can I borrow. They don't want to operate your business either. So they don't want to come in there and tell you, well, you don't have a policy and procedural manual. Maybe you should be buying from this vendor over here instead of this vendor because that vendor we don't like, or, they don't want to be a hands-on business operator. Thus, the banks typically get less of a return, as I mentioned, than an investor would. Investor is going to look for or an equity partner is going to look for a very high rate of return. Okay, next slide. Banks look at all of your information about your business. Most businesses are owner occupied, and the key principle is the business for all practical purposes. So they'll look at the 4 C's of credit, which have been around for a long, long time, on the principle. They look at character, capacity, collateral, and capital. From a character standpoint, all banks will, at some point in time in a credit review process, will pull your personal credit history. And I always tell my clients to do that before we go into a bank so we know what the score is. Most banks will not do any loans that people have credit scores under 650 unless there's circumstances surrounding a lower score than that. So again, keep that in mind. Your capacity is the ability of money that you generate in your business added with the non-cash items like depreciation and amortization. Take that figure and look at all of the principal payments that you have to make over the next 12 months. And they want that revenue and non-cash items to equal all those debt payments by at least 1.25 times. And that 1.25 is probably on the low end. I think they're going to be looking at 1.35 or 1.45 going forward. Collateral is, again, for a way for them to get their money back. And so they're going to loan some percentage of the value of that collateral. Real estate is very easy to do. You can get an appraisal. Equipment, sometimes it's harder because they have to have somebody do an equipment appraisal. I always tell my clients, and I think Gerald mentioned it too, if you've got cash in your checking account and you want to buy that new vehicle and you go out and buy a $50,000 truck and you pay cash for it thinking that, well, if I ever need money, I can go to the bank and get $50,000 on that vehicle. That vehicle, just like when you drove it off the showroom, is not worth what it is today or was. So you're not going to get that percentage or anywhere near the value of what you paid for it when you try to get finance. So again, preserve your cash and go in and get a loan for a percentage of the value. At least you'll have it locked up for a longer period of time. And then capital, banks don't like to loan 100% of anything. And so typically they'll loan $3 for every dollar you have invested in the project. So again, don't walk into a bank and expect that if you need $1 million for a project that you're going to get $1 million. They're going to want you to have some skin in the game. Okay, next slide. Bankers today, for the most part, are overworked and underpaid, just like any profession. And when they walk in the door in the morning, they have past due reports, they have collateral exception reports, they have meetings to go to, they have loan committee, they have sales reports to figure out, they have meetings like this to attend, so they're constantly doing something. And so if you take a presentation or the thing that I mentioned earlier, you walk into a bank and say, how much can I borrow? You're probably not going to get a very good reaction, and it's going to take you a long time to get any kind of response. You got to present your bank a fully developed business plan with all the required documents. If you do that, and I'm going to show you on the next slide a little bit about what that looks like, your request is going to move to the top of the pile because they don't have to do as much work on it. And so if they don't have to do as much work on it, they can move it along through the system, and it'll get you a much faster response. And then again, plan ahead. Don't wait to the last minute and go into your bank and say, hey, I need a loan to cover my overdraft because I got a big check coming tomorrow that's going to hit. So that's going to be a real difficult thing for you to get done. So plan ahead. Okay, the next slide. Here's the format that I've used over the past 7 years in dealing with my clients taking requests to banks. And it's a business plan, which they all want. The narrative they'll read through and see that you've done your homework. They all turn back to the back section and look at the financials and make sure you can cash flow it. But all of these sections need to be very detailed. And again, what you're doing here is you're cutting the number of questions down that they're going to come back and ask you. Well, what about this? Or what about that? Who are your clients? You know, do you have an aging schedule? Who are your competition? What do you do for marketing? If you give them all that information in one packet, all neatly compiled with copies for them, and some banks will want you to, after you presented it to them, send it to them electronically so they can cut and paste and put their loan package together. But if you do all of this and you take a look at a background in history, that's probably going to take you more than one page, because that background is going to be, when did you incorporate? Who's your accountant? Who's your CPA? Who's your attorney? Put an organizational chart in there. What do those people do? How long have they been with you? And how long have you been in business? Do you own your own property? Do you lease it? How long is the lease? You can kind of see the information that starts to build up, and it's a very interesting process to go through if you've never been through it. But it's also very eye-opening, because sometimes you haven't done some of these things in quite a while, and it puts you on a new direction. So next slide. I always tell my clients that when was the last time you called your banker up and says, hey, can I buy you lunch? Can you come out and see my operation? You have never been out here. You haven't been here in a long time. We've done remodel. We've added on to the back of the building. We're doing this and we're doing that. And why you do that, and why that's so important, is that when your banker, your account representative, takes your loan request to the loan committee, I can guarantee you, because I've been through tons of loan committees, there's always some banker that sits in the back, doesn't ask a whole lot of questions. And then when the Q&A piece comes open, they'll ask a zinger of a question. And the loan officer will be like deer in the headlights. And so then that takes the other bankers that are in that loan committee, and they start piling on the loan officer and asking a whole bunch of questions that the loan officer probably doesn't know, because they've never been out to the company's operation. That loan officer is your voice in the loan committee. You can't go to loan committee and sit there. So you want to make sure that that banker has as much information as they possibly can about your business. So when that crusty old banker in the back says, well, isn't there a nuclear waste dump across the street from the property? Instead of you saying, I don't know, you can say, yeah, there used to be, but it's all been cleaned up and everything is fine now. That will cut down on the number of other questions that are asked, because they know that you know what you're talking about, and they've got a good handle on the business. And again, total offer up your whole banking relationship. Next slide. Now we're going to get into dealing with your bank on an ongoing basis. And I came up with a David Letterman top 10. Maintain all your insurance coverages and provide copies. Most banks have what they call a collateral exception list. And if you don't have insurance coverage on your building, or they're under your loan agreement, you're supposed to provide them annual liability insurance coverage, and you don't do that. Okay, so your name now is up on a list that says haven't provided the current copies. Well, again, this list gets circulated around bankers that are on that loan committee. And if they see your company's name on that list, the overdraft list, exception list, they're going to think, okay, this guy or this person really doesn't take a whole lot of control or interest in his business, because they're always showing up on our list, and that's not going to be a good thing for you on the approval process. So make sure before the bank calls you and says, oh, we haven't got your insurance, have your broker put them on a timetable where every time they send you a copy of the policy, they send a copy to the bank too. Pay all your taxes on time. One of the big red flags that bankers look at, there's a lot of companies that when people don't pay their property taxes, well, you'll get a notice that, well, we'll loan you money to pay for your property tax. Under the law, that entity, if you do take advantage of that and they sign you up to pay their taxes and make you a loan to you for that, they have to notice the first lien holder, in this case, the bank. So that's a big red flag for lenders, that the person that I have a first lien on my property is borrowing money from another person to pay the taxes. And oh, by the way, the taxing authority moves ahead of my first lien. So now that lender is in a second lien position, which is really going to make them nervous. Number 8, provide complete and detailed personal financial tax returns. I used to get a lot of people that would provide just a one-page, the front page of their tax return. The bank's looking for everything. I mean, don't feel that you've got to hide something from the bank. They'll find it out anyway. So make sure you include copies of the K-1s so that they can continue to analyze your cash flow. Provide current and detailed personal financial statements, including the value of your business. One of the things that a lot of people would leave off their personal financial statement is the value of their business. And that's probably one of their largest assets of all. Another thing I would see would be counting a truck or a vehicle on your personal statement, and it shows up also on a business statement. Again, things that kind of look like you don't know what you're doing financially. Number 6, provide current and complete business tax returns along with the personal return. Okay, next slide. Number 5, provide current detailed financial statements, including aging schedules, accounts receivable aging, accounts payable aging. They're going to want that information, so provide it. Some under loan agreements, you may have to provide anyway, quarterly or monthly. So provide it before it's due. Don't overdraw your checking account. Banks see that as a big sign of weakness when they're always on the overdraft list. And plan ahead. I can't tell you how important that is to plan ahead and not wait to the last minute, because number 2, bankers hate surprises. And then even if you've got bad news to share, maintain an open line of communication. I used to have a lot of clients when they couldn't make their payments or they couldn't provide their financial statement, go silent on you. And banks really hate that. They want to have an open line of communications, and you should want that too with your banker. Okay, next slide. This is what you want with your banker relationship. You want smiling faces, handshakes, and extremely well beneficial relationship to both parties. Next slide. So in summary here, choose an experienced banker with decision-making powers. Make your banker your advocate. Provide your banker with all the information in a timely manner. Plan ahead, don't surprise your banker. And offer your banker all of your business, not just a single transaction. And always maintain an open line of communication. If you do these things with your bank, I can guarantee you, you're going to have a really good banking relationship that you can carry well into the future as your business grows. That concludes my portion. Bill, back to you.
Dick, thank you very much. Boy, there's an abundance of information there. If you go back one page, Doug, I'm sorry. Real quick in summary, kind of for the last hour and a half, we've talked about several things, but I just want to highlight a couple of them for you. One, we start off with making sure that you understood your financial statements, and more importantly, they were accurate. Make sure that you have someone that helps you do that. It's really cool to say that you're $1 million business, but if you have no margin, you have no cash, you have problems. So think of revenue as vanity, margin is sanity, and cash is king. Analyze your financial statements through key ratios and act proactively. Use tenets to define success, not a dollar amount, but the operating aspects of that. Have a good rolling plan, 3-year plan, and a very detailed 1-year plan. And as Dick really highlighted several times, be very proactive with your banker and investors. That's really the balance of our prepared talk. I would like to thank you for your participation today. And we're going to open the lines up for some Q&A. So if we go to the next page, You can either just send in a general question and we'll get it to the right person, or you can direct a question specifically to one of the speakers. So please.
Oh, we already have a couple of questions that have come in. First question, can you please re-explain the difference between financial accounting and management accounting?
Jim, you want to take that one? I'd remind the panelists to just go live so we can just very quickly get through the questions.
Yeah, no, I'll gladly do that. Financial accounting is external. Oops. Financial accounting is external facing accounting. Management accounting is internal accounting. For example, maybe you have a more robust inventory tracking on your management accounting than you do on financial. So it could be that you monitor and measure different costs and different things for the sake of bonuses to your salespeople or your production person. So again, it's just a different audience. Management account is internal facing, financial reporting is external facing.
Thanks, Jim.
Okay, that's great. Next question, is there a best time to write off obsolete inventory? Is it 6 months? Is it 1 year? What's the guidance on that?
I'm going to ask Gerald to handle this, but I used to always tell people, think of inventory as cash sitting on the shelf. And so that have that visualization, then you can act. Gerald, what was y'all's rules related to obsolescence?
So the product that we had really had no technical or minimal physical obsolescence as well. But I already actually answered this and typed in an answer, which was when you've come to determine that it has no value or the value you paid for it, that's the time to write it off. Because the question was, is it 6 months, is it a year, is it 1 month? It completely depends on the product and on its technical or physical obsolescence. For example, if you had a carton of milk and it was 6 weeks old, it has no value, you need to write it off. The best practice, in my opinion, though, is that over time, if you see that something's not selling, you should begin to slowly reduce its value on your book so you don't take it all that one hit in 1 month. And then when you finally come to the conclusion that it really is valueless, then I think that's the time to bite the rest of the bullet and kiss it goodbye.
Good point, Gerald. I think you have to become very honest with yourself, and your customer does tell you by how much of that particular thing they're buying, but be honest with yourself. Doug?
Hey, Bill?
Yeah.
Yeah, I'll add a comment to that too.
Sure.
I think in this year we've got in front of us, 2020, most businesses are not going to have really great financial statements. So if you've got things on your balance sheet that have been on there for a long time and you want to get rid of them, I would say take them in 2020 because you're not going to have to explain as much because everybody's going to have the same messy financial statements. So if you've got anything like that, old inventory or notes payable to yourself, take them in 2020. It's going to be a big benefit for you in 2021.
Great point, Doug.
Plus, I would add that from a tax perspective, you're getting at the best cost the best reduction in your expenses if you actually write it off.
Yeah.
Doug?
Just to make a point, several people have asked, will these slides be available and will this recording be available? And to reiterate, yes to both. We will be sending some follow-up emails to all attendees here. Number one, we are going to ask you a survey. We're going to ask for your feedback on how this was for you. Did it help you? You know, the overall content and presentation. Plus, we will give you some links on how to get to the information after we're done here. I think that's it for other questions. I haven't seen any others come in.
We'll hold here for a couple more minutes to see if there is any other questions. And I would encourage you, there was a lot we tried to share, and obviously we could have gotten a lot deeper as we tried to skim across a very intense subject. Please feel free to relook at the video or pull out the presentation, go to a couple slides that potentially didn't quite understand, or you might have questions about, and feel free to send an email to any of these, any of the folks on the panel. We'll be happy to respond to you, and then we can move forward from that. But if there are no more questions, I would like to
Bill,
thank you.
we do
I'm
have
sorry.
one last comment, more a comment than a question. It's a very valuable one. Don't forget that if your company has surplus inventory that you're wanting to write off, if it's got any kind of usable value, there might be some area nonprofits that could use it. And be sure that you explore those options, kind of a give back to the community.
Let's get credit for a contribution. So if we have no more questions, we'll go ahead and sign off. And I want to thank everyone for participating with us today. We do have some more coming in the future. So periodically come to our website and see what's going on related to the Silver Foxes. And stay safe out there, and good luck with each of your businesses. And just remember, one day we'll all be telling stories about 2020.